If you're self-employed or run a business through a company or a trust, the way banks assess your loan application is completely different and often misunderstood. That's because traditional lending is built for PAYG borrowers, not people like you with complex structures, varying income, and cash flow spread across multiple entities. At SF Capital, this is our core niche. We've helped medical professionals, accountants and lawyers, and clients who work in building and construction, e-commerce, hospitality, and everything in between to structure their finances and unlock borrowing power most brokers would miss. By the end of this video, you'll know what lenders really look for and how to prepare before you even apply. Why certain entities should be included or excluded from a finance application, how to use accountants' letters, servicing strategies, and add-backs to your advantage, and real-world case studies showing how we help clients approve loans from $400,000 to $4 million by presenting their finances the right way. So whether you're trying to upgrade your home, buy an investment property, or restructure existing debt, you don't want to miss this one. Let's get into it.
Okay, so we're going to go through the concept of flow of income, very important for a self-employed client. Number two, the concept of control and being able to control your business, control your income. Number three, linked to 1 and 2, is whether to include or exclude an entity in presentation for financing. Number 4, 5 and 6 are one bucket, which I've grouped together, which is looking at how to then adjust the income or the servicing for the optimal result. So looking at add backs and deductions, addressing volatile income, and then whether we need to factor in any related party loans and tax debts into someone's situation. And then finally, the role of the broker and the accountant and notes and letters of advice or letters of comfort they give as part of the financing process. Okay, so basically, once all the analysis is done, how is that packaged up and presented in the right way so that you as the borrower has the best chances of an approval? All right, kicking off with topic number 1. We're going to talk about the flow of income. And what does this mean? Think of a waterfall or even water flowing from the tap. It doesn't come from nowhere. It has to come from a source. And with a business owner, no matter how intricate their structures or their setup, the cash flow, their income has to come from somewhere. And understanding that is a key part to establishing self-employed income, okay? So all income, whether it be for financing or just generally showing to your accountant, it has to come from some prior effort. Okay, so that could be an exertion of skill or labor, someone working and exerting effort, whether they're a plumber, a tradie, a doctor, a surgeon, a consultant, an accountant, lawyer. That person is exerting effort to produce the income, okay? And then, or it could be from past effort. They've exerted the effort, they've built up capital, and then they're putting that capital to work to then produce the income. So we really need to understand where income starts and what is the start of the tap, the start of the waterfall, or what's their cash cow or golden goose that is generating income. But we don't only look at where it starts, we need to look at where it ends. Okay, so how is that income eventually received? That the concept being the business principal, business owner must eventually receive the income directly or in entities that they control in order to use that income for servicing. Very key concept. Okay, so it's not just you're producing the income and you control where it starts. You also must receive the income and control the income where it's received. And any income that's not received by those borrowers or guarantors is a concept that we call leaked income. It's income that doesn't end up in your pot, in your bucket, and it becomes leaked from the servicing. Okay, so let's look at the standard self-employed structure. And when I say standard, this is the template for wealth creation and for wealth creation through your business, and the structure to be able to create that income, but also draw that income out from the business in tax efficient ways and in ways that give a business owner options to receive that income, as well as receive that income in structures that can create wealth in the future. All right, so there will be, like I said, a source. It's usually a company and a PTY Ltd company, so a proprietary limited company. A company, why that is, you can watch my past webinar, but basically a company can retain earnings. So as you build up profits, you can retain it in the company, but also it can distribute dividends and have different forms of shareholders. So let's look at that. So we have the trading company, and what happens with our more sophisticated business clients is that the shares in that company are not held personally. They're not held in the individual name, but they're often held by a family trust. And if the principal of the business is the sole shareholder, the shares are held in their sole family trust. But if there are multiple shareholders, you might see other family trusts holding those shares. And then for business owners that generate high income, they might have other structures to receive distributions from that family trust. So let's look at this concept of the flow of income. So the trading income is the start of the waterfall. It's the start of the fountain. A business principal can firstly take that income out via a salary or wage or director's fees. So this will immediately appear in someone's individual tax return. That's number one. Then number two, should there be profits in the business in that existing year or retained profits, they can draw a dividend out from the company into the family trust. Okay, so from that family trust, we also learned in our last webinar that a family trust cannot retain profits like a company, or a trust generally cannot retain profits like a company. And so those profits must be distributed out to different beneficiaries. And usually the beneficiaries are the business owner or their partner or spouse, okay? And if we sent all that income to the business owner, let's just say the person on the left-hand side, they're already receiving a salary. And so the trust distributions and the dividends, which end up as trust distributions, get added to the salary. They get pushed into a very high marginal tax rate. They pay a lot of tax, as we saw as well. So what happens is that income to be able to manage the tax thresholds can get distributed to other sources, one of them being a family member or spouse, okay? Or if there's a lot of money to distribute and they want to retain profits in a corporate environment, they can distribute out to a corporate beneficiary, okay? And so this corporate beneficiary is like a water tank, if you will. If there's a tap that's flowing, this water tank, this corporate beneficiary is like a water tank where it stores up the historical profits, and then those profits can be distributed out further, again, in the form of salaries, director fees, or in the form of dividends. Okay, so it's like if there's income flowing or money flowing and you need to store it up, you can store it up and build up the balance sheet of your company, but maybe you don't need that much money in the company, or there's risk holding that much cash. So you have a dam or a water tank that you can build up that cash over time, and then choose when to distribute it out. Now, this is very helpful and needed for very, very high incomes. But if you're still managing, teetering in the top tax bracket, but coming over under in different years, this is usually enough. This structure. This is really for our higher income earners. So we will go through a case study, and you'll see that how income streaming works. These structures help with asset protection as well. Okay, so let's look at a case study. We have in our client base a self-employed architect. He worked for someone for a number of years, and then he went out on his own to set up his own business. And they've been trading now for over 6 years. It's a boutique practice, very profitable, high performing, but really just a husband and wife team with a junior architect and some casuals working. So a pretty low cost base. Really they can operate in quite a boutique way and do higher end work. And their structure is exactly this structure. Okay, so architect business, family trust holding the shares, and then a corporate beneficiary. Okay, they were an existing homeowner and they wanted to buy a new home. And this is as clean as it gets in terms of this template structure that I'm talking about. So what we do is we'll go through all the financial statements of that structure, the business, the family trust, and the corporate beneficiary. And we'll also look at their incomes personally to see the flow of income. So in the FY24 financial year, the business made a profit of $345, very negligible add backs. From the $345, they distributed $258. That $258 was received by the family trust. And in some family trusts, there's a lot of expenses that run through it as well. Buying, selling of investments, that sort of thing. But this was very clean. The $258 was distributed straight on to a corporate beneficiary. Okay, and the client and his wife both received $100,000 each. Okay, so we look at this flow of income. We then pick and choose what income we are using for servicing. Okay, so we've taken out some minor deductions as well in their personal incomes. And then from this, we're able to rigorously test servicing in the calculators. And in this case, the client went with NAB, and they have a borrowing capacity of around $2 million with a very generous buffer. Okay, and so this assessment here gets mirrored in a bank servicing calculator when we submit the loan. So if we look here, we see their incomes. Okay, they have a home that they're going to convert into an investment property. So there's some rental income, and you can see the waterfall of income happening in the bank's calculator as well. So profits of $345, small add back, a dividend distribution of $258. That's the business. Then it flows to the family trust. The family trust distributes all of it. So you'll see in another scenario, more people getting distributions in another case study we'll show. Okay. And then finally, but in this case, it all went to their corporate beneficiary, and they held all those profits in there. Okay, they didn't distribute it out. And the reason for that is the tax rate in that company is 25% versus them taking it out personally. You know, if they were to distribute all that to the business owners and divide by 2, they'd be well past 180,000 in terms of hitting the top marginal tax bracket. Okay, so that's a simple example of flow of income. At SF Capital, we see much more complex structures. That was just the template structure. So this is an example of an investment banker who was a high net worth investor, someone who ran a management consulting firm. And you can see here there are different shareholders involved. And even someone who ran a movie studio or film studio. So very intricate, very complex. Green was the trading business, and the other structures were like the family trust or the bucket companies or the corporate beneficiaries. Okay, we're going to move to concept number 2, which is, okay, we talked about flow of income, but the next important thing is not just where the income flows, but do you control where it flows and do you control where it's received? Okay, very important. It might be a very profitable business, but so is Commonwealth Bank and being a shareholder, but you can't control those profits. So in small business, in private businesses, can you control that source of income and control where it's received? So from the flow of income, can you turn the tap on and off? All right. So in business, there are a lot of businesses where there are a sole principal, sole founder who controls everything. But that's not all businesses. There are also many businesses where there's business partners coming together, bringing their skill sets and having different slices of the pie. And in some cases, those slices of the pie are equal, whether they're 50-50, 33.3 times 3, 25, 25, 25, 25, or whatever the ratio might be, but they're not always equal, okay? Now, banks often prefer a borrower to have 50% or more of the business to proportion out their profits to them for servicing, okay? And that concept is really easy to understand. When it's 100, you only need to convince yourself to take out the money. Okay, you can decide independently, should I draw a dividend? Should I increase my salary? I showed this in the last webinar as well. But as soon as you have a business partner, there's one more person you have to convince. And it might be easy to convince them when their values and their financial position aligns with yours. Maybe you both started the business in your mid-20s, and you're both eating ramen noodles, maybe renting or living at home. But as life goes on and people develop different preferences, they marry, their investments go good, their investments go bad, their health changes. People have different priorities, and so even one person can become harder to convince to take money out. But what if there are more shareholders? It really becomes harder and harder to convince the other shareholders and directors to be able to take extra income out or income out generally whenever you want, in terms of timing and in terms of quantum, okay? So when it's less than 50%, banks start changing their policies in terms of deciding how much income you can use for servicing, okay? And look, a bit of a technical note. So I'll show an example, but a bit of a technical note. It can be controlled if you're a really savvy founder and have a lot of shareholders and start issuing a lot of shares. It can be controlled by classes of shares, but this is probably self-employed lending 103. Okay, I'm just planting the seed that you can control. You can have a lot of shareholders, but control the classes of shares to then determine how income is still controlled. But yeah, I'll save that for a future topic. Look, just going back to, say, this example. So when it's 100, a bank can use this salary plus 100% of the profits, okay? That's why we also used 100%, that's why we also used 100% of the profits and their salaries, okay? When it starts going 50-50, a bank usually can still take 50% of the profit and, of course, 100% of the salaries, okay? So you would end up dividing this figure by 2. But when it starts going below 50%, and say it's 25-30, some banks will not let you times this profit by 25 or 30 and use it for servicing. It has to be the income you actually take out. Okay, so we'll see an example where, yes, they'll use the salary because you control yourself 100%, but the percentage of profits taken out can no longer be applied for servicing. It must be a proven dividend. Okay, so we'll show that in a second. That's the point I wanted to make here. Yeah. All right, so let's look at a very complex structure. So I showed the textbook structure, the template structure. We're going to go to one structure now. I would grade it like close to 10, if not 10, in terms of complexity for a dental group. So this principal and business partner own 10 plus, even more dental practices. There are multiple entities and trusts everywhere. They're 50-50 in partnership, but there's some quirks in there as well. There's existing business debts, and they have a pretty decent investment portfolio as well. The client wants to, linking to our previous webinar as well, next home buying, our client wants to upgrade their home. They've worked really hard, they've built up their income, built up their wealth, and they want to be able to enjoy the fruits of that hard work and their efforts by buying a new home for their family, okay? All right, so let's look at a really complicated structure. This is a much more intricate structure for a more sizable business. So you see these different entities that we've been talking about starting to come together, okay? So there is still the top of the waterfall or the fountain. There must be a golden goose somewhere. There must be a cash cow somewhere that is generating the business income, okay? And so it went from our client being the dentist at the chair working, and they're still the dentist at the chair working, but to a number of dentists at their chairs at their different practices working, okay? And what happens when you're a bigger business group? You start using structures more and more to your advantage for the business as well as your personal wealth, okay? So the first thing that gets introduced is, because there are a lot of practices now, a lot of different sites and chairs operating, one of the things that gets introduced is a services trust or a services trust or a services entity or management entity that starts collecting corporate fees or management fees from each of the sites. And that's because the founders are no longer just principals in themselves operating at the dental chair, but they do have to operate as directors, managing directors, CEOs to operate the group. And there is corporate overhead that starts being necessary to manage a group of that size. So you do start needing HR personnel, a finance department, someone that helps with marketing, and they aren't working on each individual dental site or each individual location. They're working together collectively for the benefit of the group. And so usually a separate company gets set up to manage the corporate parts of the business, okay? Not all businesses have it separated out. It's often a thematic in medical practices. Also sometimes, I'll say it's a thematic in professional services, dental groups, accountants, legal groups, where there might be a separate structure just managing the corporate overhead. Next is, so I said they have multiple locations. Next is an entity that just takes out the leases, okay? So why they do this is to make the obligations between the landlord and tenant separate from their core group. Okay. Now there's bank guarantees. There can even be directors' guarantees sitting behind that, really tying back in the company. But putting all the leases in a separate company can make it more transactional and separate out the risk. So, for example, if they want to vacate one site, they can do that more easily without affecting the liability of the main business. Then, as you get more established, this business also owns a couple of the properties which their clinics occupy. And so there's even separate structures that just hold the properties. okay? And that they do this so that the properties can again become separate and part of their personal wealth rather than their business wealth, okay? So there's an operating entity and then a property, there's a opco and a propco, okay? Operating company and a property company. And so the flow of income then becomes a little bit more intricate, shall we say. So in this group, key example of leaked income. This income is leaked. They're paying rent externally. I mean, that's naturally goes to the landlord. This income gets captured. Okay. Corporate fees get captured in the services entity. Rent gets captured in the rental company. These aren't leased entities. These are owned entities. And now the income starts flowing. So dividends will flow to our client's family trust. Distributions from the services trust will also flow to the client's family trust. The rental income minus the expenses, this is another trust. Distributions, actually in this case, the distributions, there's a intermediate or interposing trust here that holds half the units in the property trust. But then distributions in this case flow directly to our clients. Interestingly, they could have flown to the trust, but they went to the client directly. And there's even one satellite office where they're not the 50% owner, where 40% distribution flows to the client's trust. Okay, so the trust is I won't say a bucket. It's like a valve, if we'll say. Water will hit here or money will hit here, but it cannot be retained if there's profits in the trust. So from the trust, income then flows to the client. So distribution goes to the client. Textbook example, a distribution goes to a corporate beneficiary, a holding, a bucket company or a holding entity for retained earnings. And distribution even goes to another trust that holds an investment property. Okay. Looking at other distributions, our client has more speculative investments in another trust. So startup investing, shares, things that are non-property. And then he has another couple of investment properties in another trust. Okay, and of course the profits from here, these entities cannot hold the profits and must distribute. All right, so just one more thing to cover off. He has another commercial investment sitting on the side, in conjunction with his wife, where he also gets 50% of the rental income, and then there is also income from him sitting in the chair, looking after patients as well from his own ABN. Okay, and so just one more thing. Okay, so you can see how income is flowing from business, from property and investments, and then you can see how income is being distributed to the client, to corporate beneficiary, to another trust. But there's one other thing. So from the family trust, there is a distribution to his wife. Another example of leaked income. So unless she is captured as a borrower, the income will get leaked. Okay, so if you can imagine, like zooming out in this picture, a ring, what do you want captured in the ring? This is what we look at to determine how we present a client to a bank. So to determine that, okay, we're going to talk about point number 3. What do we actually include or exclude in our presentation to a bank for servicing? Okay, and when we do this, we ask a series of questions, or we look at a series of questions. Okay, so I first look at, or my team and I look at, do we have a choice in the first place? Is it part of the flow of income? So you can't present a client without presenting the source. It cannot work. Otherwise, the bank goes, okay, is this from illegal activity, for example? Like, or, how is this person earning income in the first place? How do I know he's of good character, good substance, earns the income reliably, credibly, and legally? Then, of course, is there control? That point, the first 2 points. Then we look at what is the impact on serviceability. Is it profitable? And are there other attributes of this entity that really boost servicing or bring down servicing? Okay. And then when we answer all this together, I have one final question, which is it even worth it in the first place presenting that company or presenting that entity for servicing? Or is it just too much effort? So from that client, I showed you the nice picture in terms of the flow of income diagram or the corporate tree or the corporate group structure. This is the work that actually goes into answering those questions. So my team and I will go through each financial statement, the trading business, the satellite office, the services trust, family trust, bucket company, investment vehicles, the property trust, and then finally our client, right? We'll look at how the income is flowing in and out, and then I'll ask these questions. Is it a source of income? Yes, 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 no, 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 whatever the answer might be, okay? Is it a recipient of the flow of income? And in this case, our client controls a lot of it, so I don't need to see if it's a minority holding. Everything is 50%, except for this satellite, but I'm still including it because these dividends are pretty consistent. These distributions are pretty consistent. Is it a source of business income? Is it a source of investment income? Are there no loans in the company? Okay, loans have to be factored into servicing in a lot of cases. Okay, and is it a yes? Is it a no? And then finally, is that entity even profitable? If it's not profitable, it drags servicing down. All right. So from these questions, I can then make a decision whether to include or exclude the business for servicing or that entity for servicing. And so what the goal is from this structure, it's very complex. It's hugely time consuming for us, for our client, for the bank to collect all the documentation and evaluate it for servicing. So what we try and do is understand the complexity and then simplify it as much as possible to get the core essence of the file, of the deal, to get the sufficient number to get the borrowing capacity they need to achieve their goals. That's the aim of the game. That's the outcome we want. And so from this complexity, it's not that much simpler, but in the end, we're going to present this. Out of that structure, this is what really will get the loan approved. We have the source of income, we have the golden goose, we have the distribution to the services trust, we're capturing all the business related income, we're capturing what goes to our client, and then we're capturing where the income ended up, because these are entities that they control. Okay, so we're looking at the flow of income and we are establishing and presenting to the lender for financing what they control. And of course, here they control 50% of this commercial rent as well, and they control their physical efforts working as a dentist. And so that is included as well. Okay. So in this case, when we do that, look, I won't go through the property portfolio. It's quite significant. But with Macquarie Bank, they could borrow $4 million. Now, I know that's a big number, but this guy works hard and has worked on this dental group for over 15 years or so. So this is kind of the borrowing capacity that we're able to establish. Now, if we include the loans, we do the business debts, we do get a different result. But this is even more advanced again. It can be complicated and drag down servicing using a bank that will factor in the business loans as well. So, but that's another decision and another complexity webinar 103 perhaps. All right, so moving on, we talked about flow of income, we talked about control, we talked about entity exclusion. So we showed how complicated it can get. I showed all the numbers that we looked at, okay? The goal, this is a quote from Einstein, which I really like, which is, everything should be made as simple as possible, but not simpler. Okay, everything should be made as simple as possible, but not simpler. So we have looked at the complexity to really dumb it down and streamline it so that we can get the goal, that we can get the outcome. However, I cannot make it simpler to get the outcome that we want. Okay, and this is something that you guys need to know, to keep in mind. There can be a baseline, a floor, a minimum threshold, especially for the clients that we handle, where it cannot be simpler. Okay. And I really, to my team, I really want to emphasize that the clientele we handle, we got to fight and combat this desire to be too simple by the banks. That is not our client base. That is not who we are and what we're good at. We have to embrace the complexity. Okay. So it doesn't mean that it can't be simple, but it can't be simpler than what it is. Okay. That's the message. Okay, so how do we actually exclude those entities? Because they will come up, I forgot to say this, they will come up in searches, in directors' searches and things like that. So when you lodge a loan, or when you prepare a loan for lodgement, something we always do is look at someone's credit file. And in the credit file, we'll reveal all the directorships. You cannot hide it from a lender. So all these other entities we're not using will pop up. And so what we need in order to exclude those entities is have good notes or an accountant's letter that tells the bank, hey, you don't need to worry about this company because it's either trading profitably with no external liabilities. It's trading profitably but can meet its own liabilities. It's not trading, so even though you can detect the directorship, it doesn't trade at all. Or it's closed. So similar to the one before, you can see the directorship, but this entity is being wound down, it's closed. It's there in terms of still ASIC records, but we don't need, nothing's going on with this company anymore. Where it becomes hard, and this will become a conversation point later, is where a company can meet its obligations and its commitments because of its funding sources, but is not necessarily profitable in an accounting sense. This is a big gray area in retail lending, resi lending, which I personally don't like. And a lot of brokers, accountants, and the finance and business community don't like it. But yeah, banks, a letter that just says this company can meet its obligations or meet its liabilities is a question mark, and at this point in time, insufficient. So I just want to share with my team that this type of entity, you can't just write a letter saying can meet its liabilities. All right. Next thing I want to talk about is add backs and deductions. Simple accounting concepts. Profit is not cash flow, okay? Just like a unicorn is not a horse, or a horse is not a unicorn, okay? You cannot dress up, just like you can't dress up a horse to become a real unicorn. You can't dress up profit to be cash flow. At the end, cash flow is king, okay? If a business is reporting a profit, even with the accounting rules, it does mean economically, it is producing results that have economic value and should result in cash flow, okay? But it's not always the case due to accounting rules and timing that profit and cash flow match. In fact, they don't in many instances. So profit is determined by accounting rules. This is very much the realm of accountants. I'm not going to pretend or tell you a bunch of accounting principles to get to a client's profit. But from a financing perspective, it's important because some expenses are recorded and impact profit, but actually don't result in cash being used. The reverse is also true. Some things can be recorded in income, but don't result in cash being received or generated. Okay, so the classic non-cash based expenses, which get recorded in your P&L and lower the profit, but can be added back, are depreciation and amortization. Cash flow, however, is very hard to fake. It is money in your bank account and money flowing in and out of your bank account. Okay, it's the real debits and credits. Sure, not all that money might be yours eventually because you've got to pay out expenses, pay out creditors, but cash flow is the real money going in and out. Okay, it's very hard to fake cash flow. You can adjust profits, but very hard to fake or adjust cash flow and what's coming in to your bank account itself. It also, cash flow, if you actually look at a cash flow statement, it also takes into account things that change your balance sheet. Okay, so capital expenditures, loan repayments, the full repayment. So your P&L, your profit and loss will only record the interest expense, but your cash flow in your bank account and your cash flow statement will also record the principal payment out. So ultimately, cash flow is the most important thing for repaying a loan. Now, bankers use the concept of earnings before interest, tax, depreciation, and amortization. It's just a proxy for cash flow. It's not really true cash flow because you got to take out the tax again, for example, and you got to, if you have a loan, and you're paying principal, you got to take out the principal as well. But this is a concept that is thrown around, used in practice as well as a proxy for cash flow and conversations around cash flow, and also sizing debt. You might hear, especially more in commercial lending and unsecured lending, it's the loan is 2 times EBITDA. The loan is 3 times EBITDA. So this concept is very related to what ends up used for servicing, because you will take the net, like when we present a client, we'll take the net profit, add back things like depreciation and amortization, and then the calculators will take out taxes, and they'll take out interest expenses when you load the loans into servicing as well. Okay, so knowing profit and cash flow are two different things. The banks do allow things to be added back and deducted as well. It cuts both ways. So there can be add backs. So we talk about depreciation, amortization. They're the textbook things, but there can be other things that can be added back as well. So these can be one-off expenses that hit a P&L, but may not recur on an ongoing basis and will not occur again in the next year. So it could be a fit out, starting up and fitting out, or even a renovation. Okay. It could be education expenses. So I did an MBA, but I'm not going to be doing an MBA every year. It could be recruitment expenses or some sort of marketing campaign that you might do one-off. Or even even when you let someone go, you have to pay a redundancy payout, and you're not planning to make team members redundant every year, and you incur that cost on a one-off basis. This can be added back as well. So what we do when we do add backs is we're trying to adjust or normalize the servicing income, or the EBITDA, to get to a truer number, or more reflective number of the ongoing performance of a business. Okay, but it swings both ways. So while you can add back one-off expenses, you must also deduct one-off sources of income. So for example, if you sell an asset and it books a profit on the sale, then you got to deduct that gain on sale. If you made a bumper profit from a one-off project, like you might have done a partnership or a JV for an initiative, you might have made really good income from that project, and then it closed. that might not be ongoing, so that can be deducted as well. Or sources of government funding. So it's a bit past its time, but there were banks who were not willing to take JobKeeper or COVID income. There were banks who were not willing to use JobKeeper or COVID income. It had to be deducted. Okay, and also these help to normalize the earnings as well. Look, a good framework to think about add backs is there are non-cash based add backs and there's cash based add backs. And then these can be very standard and easy to get with a bank or not standard at all. Okay, so depreciation and amortization are the classic ones. This is very easy to add back. Okay, with most lenders, it's well known, accountants, lenders, that these are non-cash based expenses. They hit the P&L and impact profit, but they don't impact cash in that year, that is. All right, so then there's interest expenses. Okay, you can add back interest because when you add it back and you take out the principal and interest, you get the true cash flow. Also, one-off gains and losses, specifically one-off losses in this case can be added back. Okay, so these things are very easy to add back. The harder ones to add back, and we'll go through a case study to look at this, are trust distributions that get leaked to people outside the ring, or trust distributions that get leaked beyond the borrowers and beyond the flow of income being presented to the bank. Very hard to add this back, but I'll give an example of when we've successfully done that. Tax offsets and R&D rebates, also very hard to add back. Bad debt expenses. These are a little bit less understood by banks and your normal day-to-day credit officers, and harder to get back. In terms of cash-based expenses that are non-standard, it's everything else. Okay. Now, I'm not saying it's non-standard and therefore hard. It's just that the onus of proof to get this add back is going to be on the borrower, and of course on the broker, or on the borrower with the assistance of your broker to get it back. So if you've made a cash-based trust distribution, so some trust distributions can be recorded first and then paid out later. There's something technical you can talk to your accountant about, or trust distributions within the year that get paid out. Fit outs, education expenses, recruitment, redundancies, like I talked about. You might have gotten you might have made a legal payout to settle a matter. Capital works, relocation, startup costs, marketing projects, or you may have restructured your business to lower the costs, like you've cut staff, cut different subscriptions, shrunk your office. These other add backs are a bit harder to get back, and they need further evidence, further support. Okay, let's go to the case study and I'll show how this has worked. Okay, so one of our clients is a commercial cleaning business. It's a long-running business, like a family business as well. Husband, typical business owner, doesn't get made much of a salary, but draws on the dividends of the business, draws dividends from the business. Wife is a finance manager, good income, good at 150,000, and they have a home they're happy with. But the next home in this case is getting a pre-approval to purchase an investment property, and I guess from the fruits of the business start creating wealth personally. Okay. The business was very profitable, but there were business debts again, and 50% of the dividends were being distributed to family members. Not written here, but there are also a bunch of different add backs that we had to make. Okay, so in their scenario, profit was 662. They bought some equipment that was able to be written off in the same year. So we have that added back. amortization is a normal add back. Interest is a normal add back. And then they had some other equipment, which was one-off as well, which we added back. Okay. But then there was a number of deductions. Okay. There was interest income being deducted. This is from a related party loan, which we'll talk about later. There was capital gain. There was a settlement on an insurance claim, and there was a dividend distribution of $225. But half of this was leaked to family members. Okay, and so this is what it looks like when there's leaked income. The profits are pretty good, right? From the profits, they paid out a dividend. But from the dividend, half went to the client's mother and father. Okay, so some of it went to the client's wife, some of it went to the client. So from their 100K, they're adding another 105,000 to their servicing income. But some of it gets leaked. Okay, so husband and wife are borrowing together, but when it gets leaked to family members that do not become borrowers or guarantors of the loan, it is very hard to get this servicing income back. Okay, very hard, but not impossible. Okay, so this is what we've had to do to get this income added back. So the first thing that it requires is, of course, understanding the scenario. Okay, but number two, testing it with the lenders, whether they can consider it as an add back, but not just for any reason, based on very good reasons. So in this case, it's needed to establish with the lender that our main client controls the trust. Okay, so he's the director of the corporate trustee, and he has full discretion around the distributions now, historically, now, and into the future. Okay, and even though those distributions are made, that the mother and father are self-sufficient and not reliant on those distributions for servicing. Okay, so you actually have to ask the client and do your due diligence if this is true. So in this case, our client's parents have a home paid off. They're pretty well established semi-retirees, so there's even still income flowing through the family, and they don't need this distribution to meet their own living expenses. Okay, and then finally, it's having an accountant endorse it as well. That is an extra layer, an extra step. Okay, so this is what we had to establish with the bank to get it added back, and it makes a really big difference. So in our case, having that income there or not was the difference between roughly another $1 million in borrowing capacity. Okay, so without the distribution and then adding it back, it was roughly $1 million in borrowing capacity, which when we had all the add backs that we wanted, we were able to get. Because another important add back, which I forgot to share, is that in this case, the client also had a 6-figure R&D grant that formed part of their profit and loss as other income. And so we tested this scenario with a ton of banks, and the main answer was R&D income was not welcome as part of servicing income. However, we were able to establish it as being accepted with NAB in this case, but we had to do the due diligence that they were why they got the R&D grant in the first place. So in this case, they were building a proprietary technology platform, and finally get the accountant to endorse this again as an ongoing source of income. Okay, so getting some of these add backs is very hard work. It takes a lot of inquiry, it takes a lot of due diligence, it takes conversations with the accountant to have it endorsed and successfully added back. But it's worth it. If it materially boosts the borrowing capacity, then it does help get good client outcomes in the end. The concept of add backs is very established. It's part of a lot of bank policies that things that are non-cash or non-recurring can be added back. So team, something to read and understand in order to successfully get this. Okay, so next concept is volatile income. It's important to know that it's not just the quantity of cash flows that the bank cares about. It's also the quality, okay? So if you make good income one year, but you can't do it again and again and again, is it a good business? Well, the answer is it really depends. Some businesses are designed to just, be short-term in nature, whether it be a seasonal business or a fad or a trend. Some people go into business knowing that it's not going to be around forever. So it really depends. But banks care about you repaying the loan or a business owner repaying the loan over time. And to do this, the consistency of the cash flows speaks to their quality. And consistency means creditworthiness and bankability in the end. It's common sense, first of all, but it's been part of banking and credit assessment for a long time that banks want to see at least 2 years. However, in the last, call it 2-3 years of my finance broking career, there has been more of a trend to simplify. Maybe bankers can't handle 2 years, or they don't want to do the analysis for 2 years. But more and more banks are allowing clients to use the latest year of income alone. But it's not as established a way of assessing a loan, it's not as established. And there are some good things and bad things. So good things are, if it's a great year, you're going to get high servicing capacity, high borrowing capacity. But some of the bad things are, you might have had a good year, but your financial statements are not ready. So you have to wait for your accountant to produce the final financial statements and tax returns. And it might be a case that the banks who only look at your latest year, well, your latest year might be bad. And therefore, not looking at the consistency, not looking at the track record is going to disadvantage you. It's going to be a bad outcome for you, not opening up the books further. So just out of the big four, ANZ and NAB, banks which have started taking the latest year as given, they only really want to see your latest year if you're a normal borrower. CBA and Westpac do have policies around taking the latest year's income, but they make it harder. For example, they discount the adjusted profit by 10% to hedge for the risk of not making further inquiries into a second year. Okay, so some banks, it's textbook policy. Other banks, you got to do a bit more work, and it's not as strong, or it's more conservative looking at the latest year. All right, so just a quick case study, an example of this. Have a client who run a marketing agency. They're a father-daughter team where the father founded the business and has 70% of the shares. The daughter has 30%. Both are salaried, and there's a small dividend being paid out each year. When I say small, it's pretty decent still. So in this case, we can see this business makes pretty good income, has some expenses, has a slightly over 10% net profit margin. I won't say whether that's good or bad, but it's profitable, which is a good thing. And you can see that our client who owns 30%, if we applied 30% of the net profit for servicing, it's a very good outcome for them. So they draw a salary already of 180. If we're applying 30%, then we can add 73,000 to their borrowing capacity. Okay, so that's 250,000 presented to a bank. That's depending on your goals or your financial position. That's a lot of income to be presented for servicing. However, because this shareholding is less than 50, not every bank will want to take this straight percentage method for servicing. Okay. And so when you don't have control, they look at what dividends you actually take out. And so in this case, in the historical 24-23 year, there was 100,000, 120,000. 30% of 120,000 is only 36,000. Okay. And so when you don't have control, you can no longer use the percentage of profit method to determine servicing. You have to use what they actually take out, which in this case becomes 180 plus 36. So what, 216,000 for servicing. Still very good, but when you're allocating the profit, it becomes 250 plus. Okay, so this is the importance of control. Okay, now switching to the principle of income volatility, we see that profits shrank in the prior year. Okay, and so the reverse happens. The apportionment of profit method is yield 7,000. Okay. They drew out a big dividend because they have built up profits over the years, which the client shares 45. But the bank will take the lower of the two. So the dividend might be 45, but the percentage of profit is 7,300. They will take the 7,300. And this is what income volatility or a down year can do to a borrower and how it can negatively impact a borrower. Okay. So how do you get around this or argue around this when you've had a down year or income has been volatile? Okay. So these are different methods. There's no one-hit wonder or silver bullet. You got to navigate, explore as an experienced broker, try different possibilities. So depending on the timing, if it's before the time period where banks require the latest year's financials, you can still use the old income. Okay, so in this case, at time of recording this video, we're in October touching November, we can still use the FY24 financial statements to get financing if it's before this January to May 2026 period where banks start insisting on using the FY25 accounts and FY25 income. Another method is if you can establish enough borrowing capacity on just the salary, so 180,000 is a fantastic salary, we can just use the salary for servicing. We can use this, well, you might have to after banks start requiring FY25 accounts. But you can actually use the salary, especially when the business is profitable, in all situations. You don't need to wait till after, but you will have to after. You can start using the salary for servicing right now. Then some banks don't want to know about the flow of income. They make it simpler again by just looking at your notice of assessments and looking at the last 2 years. And so you can look at notice of assessment methods. This is offered by Westpac and Suncorp, but you might not get the richness of a full assessment that you want. It really is situational when this simpler method helps a client. Then the hardest way to get a more favorable outcome is arguing that the decline is temporary. This is not easy. It is challenging. It's hard. It takes a lot more work. But the bigger the client or the bigger the loan, it may be necessary or worth it. Okay. But you can't just say it's temporary. You need evidence and you need a good storyline as well. So evidence could be, say we're further along the FY26 year and fast forward to January or March, we can collect the interim management accounts or the interim financial statements, as well as the business activity statements, to say that business is back up in line with the prior financial year's profitability and in line with the prior year's sales. Okay. Now, it might be hard to get the very best year, which FY24 numbers, and use that, but you might be able to average out the bad year and the good year to get a sufficient borrowing outcome for your client. And then finally, another option is to not use banks, where all these methods go out the window, and use non-banks, which I talked about previously in our last webinar, and consider specialist lending or alt-doc lending, where you can use alternative income verification, such as accountant's letters, to get the loan. Now, you do pay for it with an establishment fee potentially and a higher interest rate, but this should be thought of as a temporary solution. It is a hard sell to a lot of business owners, though, who have borrowed with banks in the past or who run good businesses and are used to profits, because they're not used to the higher rates or establishment fees. Look, a savvy business owner will realize it's temporary, but it requires some convincing for a client to take this option, and then bridge back to a bank loan. All right, going on to the final topic, servicing related, and then finishing up with the broker and accountant's role. All right, let's talk about related party loans and tax debts. Now, this does transition to our accounting partners, our accounting friends. Again, I'm not going to pretend that this is our domain. I'd very much leave this in the realm of accountants, but we act on behalf of the client when speaking to the bank. And so we do need to understand these concepts and be able to speak authoritatively in order to get the loan for the client. So we know, I guess, the tipping point of when these things are sensitive or matter for lending. All right, so there are instances when drawings from the business become loans, and loans to be concerned about, or loans that need to be considered, not necessarily factored into servicing, but just looked out for in a borrower's presentation to a bank and in serviceability, okay? So in some instances, a lot of directors, a lot of shareholders take funds out of the business, but it's how they're doing it which matters. Okay, so directors' loans are actually quite easy to detect. Now, not every business owner is aware of this, but it's quite easy to detect when funds have been taken out of the business and not recorded as a dividend. So one example is you will see large interest income in a P&L, but you don't see a large cash balance in the assets and liabilities of the company, okay? That interest is usually coming from some form of related party loan or director's loan. Secondly, the balance sheet of the company will show that drawing as an asset. Okay, it's a bit counterintuitive. I'm talking about loans. It's an asset on the balance sheet because it's money to be received or collected by the business, received or collected back by the business. So money taken out by a shareholder director can be recorded as a receivable, or if that's very recent, or it can be older and be recorded as a non-current asset as well. Okay, and if it's done regularly on a yearly basis, these directors' loans can even be marked in years or vintages, like wine vintages, just for record-keeping purposes by the accountant in order to remain compliant. Okay, so there is the concept of a Division 7A loan. This is a topic that a lot of brokers, bankers shy away from. And it's also a topic which a lot of credit officers and lenders don't really understand what it is and what it means for someone's servicing, but also how it arose, how it's dealt with, that sort of thing. So I will give a shout out to Nav Neil Lal at Arnold Stevens Finlay, who I talked to in preparing for this, who helped me speak more correctly on this topic. Okay, so a Division 7A loan is a type of loan to shareholders and associates from a company to the shareholders or associates of that company. And the words associates is used because a family member can, even if it's not the director or shareholder, a family member can be wrapped into this rule and this principle. Okay, so it's designed to avoid companies and trusts being used for tax avoidance. Okay, so it's designed to prevent using companies and trusts to defer dividends, true dividends, and kick tax further and further down the road, and eventually, and basically not pay it. Okay, so money taken out of a business and permanently taken out of business should be treated as a dividend rather than a loan. It should be received as income rather than a movement of capital. So these rules are created so that money taken out can only temporarily be recognized as a loan, and it either has to be corrected by a dividend or treated properly like a loan by those shareholders and associates. Okay, so when someone takes money out of their company, it is a form of loan, and I'll talk about timing in a second. But a Division 7A loan, when it's unsecured, there's no property involved. It has to be paid back in 7 years. When it's secured, so you can actually take out the loan and put a mortgage against it, the person has 25 years to pay it back. It's almost like treating yourself like a bank. And in this case, the ATO determines the interest rate every year. So something interesting to know, okay? You can treat your company like a bank to yourself, but the ATO wraps rules around this to make sure that eventually you got to correct that situation or treat it as income. Okay, so in terms of timing, this is where I spoke to relevant people. If it's a straight loan and you repay it in full before lodgement date, then it doesn't become a Division 7A loan. It just becomes a return of capital back into your company. However, if it's not fully repaid by the lodgement date, interest gets caught by the Division 7A, and interest starts accruing from the current financial year. Okay, so in this case, it would be 1st of July 2025. Okay, interest will only start accruing on the outstanding portion. So if you took out 100,000 before the lodgement date, you put it back 50,000, the interest would only accrue on the 50,000 left, and only the 50,000 would be regarded as a Division 7A loan. Where trusts are involved, there is one more year that this can be delayed. These exact reasons you can speak to your accountant. But because of these subtle timing differences, there can be smart ways to use the funds in the business and benefit from these subtle timing differences if you're responsible with it as well. And so to be responsible is to repay the loan and return those funds back to the company. So each year, a minimum repayment must be recorded according to those years. So 7 years unsecured, 25 years secured. Otherwise, they do have to be addressed by eventually drawing a dividend out and paying the tax on it. Okay. Now, interestingly, to discourage this activity, it's all legal and above board, but it does create a delay of tax collection from the ATO, just from the way the rules are set up. So to discourage it and disincentivize it, the ATO from the 1st of July this year made those types of borrowings not able to be tax deducted individually by a person or in their trust or any other related entities. So it gets recorded as income in the business, but it doesn't. The interest on the loan does not get tax deducted anymore. It can't benefit you in that sense. So where it's useful is like knowing how this works and repaying over time is if someone has a very large profit or one-off gain that they want to streamline out over a period of time. It's not very helpful if you're consistently recording profits, generating profits, and receiving dividends. You are delaying your tax obligations in a way that can hurt you later. And a lot of accountants know this and coach their clients on this. Yeah, so it can be advantageous when used wisely, but non-compliance. So this is where you're being naughty. If you're not paying it back, that money. So when you're not paying it back and you're non-compliant, that money drawn out will eventually be caught by the ATO, and they'll treat it as an unfranked dividend. Okay, this is a loss of a tax credit, which helps you. Like franking credits kind of help your tax position, but when a franked dividend, in other words, is better than unfranked dividend, and when they record it as a dividend, it triggers the obligation to pay tax on that income. Okay, so the tax liability comes with it as well. So let's go to how it's treated and how we should look at it. Okay, so interestingly, even though it is a form of a loan, banks ignore Division 7A from serviceability. It's treated as a little bit tricky, a bit too hard. It's the realm of accountants to keep this in check, okay? And really, it would hurt servicing having to apply those repayments back into servicing. But look, there's good reasons as well why to ignore it, not just servicing. If under good advice and the funds are used wisely, it's actually good for a client. So let's look at when it's healthy. So look, what I ask myself and I ask the team to look at is the client strong and prospering generally? And are these loans under control? So it's usually under control when a business and their profits are growing. Okay. So they can maintain having this and repaying it. It's also good when the funds have been used to invest in a profitable way. Okay, so they've taken those funds and they've grown it, they've multiplied it. It's actually a good thing for the client and eventually for the ATO and everyone who's advising the client, because that client has multiplied the fruits of their labor and done good things with that money. It's also manageable or sustainable if the client is correctly declaring dividends each year. Okay, so they are dealing with it, they are addressing it, they are repaying notionally, they're reversing the loan with the declaration of dividends each year. Where it's bad is if the money is being drawn out, but you see the business not prospering. You see the business not doing well because they're essentially taking money out. They have to return it or declare it away. But the profits are shrinking in order to keep this going. Okay, so it essentially means they're taking the money out and eventually have to pay tax on it, but their ability to pay tax on it is declining because the business is declining. It's also bad when a director has taken the money out and made bad investments. This is unfortunately the risk of investing and the risk of business, because if they've taken it out, it's just like buying shares or investment property. It's worth less in the end. So you have less money to pay or correct the Division 7A loan. It's also bad if dividends are not being regularly declared because it's kind of deferring the responsibility of that loan. Okay, so it's also really bad if declaring a dividend. It's also really bad if declaring the dividend triggers a tax debt the client can't pay. Banks are very watchful for this. So in our real kind of handling of clients, we might be operating on the client's latest unlodged tax return and trying to use that for servicing. And involved with that would be declaring or recognizing some of the profits of the business, which are in a good year. But when they lodge the tax return, the tax debt is triggered, and they don't have enough funds to pay out that tax debt, as well as maybe buy a property at the same time. Banks are very watchful for this, that funds that have been allocated to a stated purpose needs to be redirected towards tax debt. This is something that banks watch out for. Okay, so ultimately, banks really hate tax debt. They do not want to deal with clients with tax liabilities. Now, they can still welcome the client back in under certain circumstances, which I'll talk about. But yeah, it's not liked at all. And that's because unpaid taxes really go to undermine a client's character. Okay, so every citizen, every business operating in Australia has an obligation to pay taxes. And not doing so just means you're not a model citizen. Okay, you're not being a responsible, upstanding citizen. And because you're deferring those liabilities, you're using the ATO as a creditor or a source of financing. It's not viewed well by banks because the ATO ultimately is the one creditor that the banks don't want to mess with. Okay, the ATO, being part of the government, can do things that subordinate the bank's debt, or they can even go into an account and freeze it, and in some cases take someone's money. So these rules are not to be messed with, and banks don't want to mess with the ATO either. If we see this with a client, how do we deal with it? Okay, so detection, I talked about before. You might see a buildup of these loans. The vintages are building up, but dividends are not being declared. That is a warning sign. The ATO portals are not clear. So in the private bank channel and commercial channel, you will see loans on payment plans or debts outstanding to the tax office. Unlodged tax returns are another warning sign, accompanied with low cash balances, as I talked about. So if they lodge the tax return, they can't pay the tax debt. Large liabilities or large tax liabilities on the balance sheet. And as I mentioned, the client is just perpetually on payment plans with the ATO. Okay, strategies to deal with this as a broker or even banker. You need to explain it or put it into servicing. That's the really quick answer. Okay, a tax debt or Division 7A loan isn't necessarily bad, but what are the reasons? So even though there is a payment plan, does the client have the ability to just pay it out? Okay, did their accountant help them with setting up the plan? If they always had the cash but chose to maintain their working capital, maintain their liquidity, it's not always bad, okay? Because another fallback is if you take the ATO repayment plan and you put it into the client's servicing and they still can service, it shows evidence of a really strong client. Because most serviceability takes out tax. Then you're putting in the repayment plan. Well, actually, that client can support 2 lots of tax obligations. Another way of dealing with it is if they've got the cash, you get the loan conditionally approved and you make paying out the tax debt a condition of formal approval. Okay, so that's a strategy of dealing with it. And then finally, you can refinance the tax debt with a business loan, make the repayments lower, and then factor it back into the client's servicing again. So this is another way of dealing with it. In a tricky loan involving self-employed financing, the broker must work hand in hand with the accountant to determine the strategy and get the endorsement needed to get a loan approved. Okay, so they are teammates, they are collaborators, they are needed to work together to get the financing for the client. Okay, usually the broker in this case takes the spearhead role because they're the lending professional, and the accountant is the support. Okay, so the first step of a broker's responsibility is to really know the client's story in the first place. Okay, when you work with self-employed clients, it's not just collecting the income, but you want to understand the nature and the history of the income, especially when you need to explain all the things we've talked about. Okay, so in subsequent conversations with the client, well, in the first conversation, you will usually get a feel or a taste of this or start exploring this. But in subsequent conversations, you may need to unpack it further. So how did you get into this business? What are your sources of income? How do you make your money? What have been the trends in sales, in costs, and in profits? What are the key drivers of your growth? Any one-off income or expenses that we need to be looking at to adjust the profits to a normalized servicing figure. Okay. Harder questions, or I guess as you build out the relationship, what your longer-term goals, or your short-term, mid-term, long-term goals? Have you experienced any challenges getting financing? What have been your roadblocks? What are your sources of equity, or how do you plan to invest further? There's a loan, but you've got to contribute something as well. What are your loan obligations? Like, what do we need to factor in today from your existing loans? And even for clients that don't look stable, are there any risks or threats to your business, and how do you intend to deal with it? Okay, this is part of understanding the client. And then it's really translating this information to write very good client notes. Okay, so this is something that we do at SF Capital. I talked about the accountant's letter, but when we present a file, we write very good client notes covering who they are, their character, if you will, their cash flow, their cash flow still, their capital, okay, their collateral as well, and then the conditions of the loan that we want, okay? We also go through how their companies are set up, and any companies we don't want to use as well, and other loans as well, okay? So when we write up this note, we are also making a case for all the add backs and of income, addressing. So we talked about R&D grant before. We're addressing the leaked income, okay? So the distribution to the parents, trying to get it back that in, and then other are still called these standard add backs and deductions, okay? So this is needed to advocate for the client in the right way and get the very best outcome when we present the deal to the bank. All right, so what I will say is, I talked about last time that if a broker is only wanting to know about your PAYG salary, that's a rookie broker. Another red flag or another sign of a rookie broker is if they do not write client notes, okay? So KYC, or knowing the story behind the client. So KYC is just, are they a real person first? Like, do they really have the identity that they're saying? But it's also knowing the story. This is the human part of finance, okay? This is going further to understand the nuances, the risks, the unique things that make up the client, and understanding their unique business risks to get them an above average outcome. Okay, so just like investing, you do your homework, you do your research to hopefully secure an above normal return, an above normal investment. Okay, so it's the same thing. We really understand the client further to achieve an above normal and above average result for our client. It takes extra work. It's harder work, but I guess if there's anyone prepared to work as hard as our clients, we are in terms of getting their lending outcome. A broker that does not write client notes, I actually would run for the hills if you're that client and you know your affairs are complex and this broker is not writing anything or writing any commentary about you. It's a big red flag, okay? You're probably gonna get a marked credit file. You're gonna have information that conflicts with what the presentation of your file should be. Meaning like if you come to us later and we need to fix that loan submission, it's gonna be hard because the bank has already received conflicting information. And it's gonna be a waste of time for you, for the bank, for us putting your file together as well, okay? So no client notes, big red flag for any self-employed application. Yeah. Of course, PAYG should have notes as well, but they can be simpler depending on the file itself. So the role of the accountant is really important in getting the outcome. In terms of knowing the client, the accountant probably knows the client more than you because they know the numbers in and out. They act as an independent authority to get the loan approved because as a broker, you and the client are on the same side trying to get the loan. The bank is on the other side. An accountant is governed by their own professional standards. They are viewed as a third party that can be turned to endorse a situation that is independently of the broker, client, and the bank. Okay, so they can ask an accountant to help with validating or endorsing not just quantitative data, but qualitative data. So soft information about the client that isn't captured in the financial statements. And ultimately, this often gets captured in the request for a letter or some form of income declaration if it was that type of loan, okay? That's usually alt-doc loans. Now, when accountants' letters get asked for, accountants are pushing back on this, which I'll show in a second. But satisfying this extra hurdle is just a sign of credibility. It's like just like that last little mile that if a client can do this, then I'm happy to give the loan. That's kind of the sentiment at this point in time or the mindset of a lot of banks. However, there is a pushback. There is a big pushback from accountants, especially for the alt-doc income declarations. There's a lot of pushback from accountants to sign these capacity to pay letters, to sign these income declaration letters. And so while many banks ask for it, there is resistance that is making it more difficult to get these letters. And ultimately, we treat it case by case whether these letters can be made available or not. Okay, so when we work with an accountant to get these, to get their support with a finance application, whether it be a letter or an income declaration, there's certain factors that we can read into whether the letter will be signed or not signed. Okay, so these letters are often signed when they know the client well. It's a long-term client and it's a good client, someone who's responsive. They're also signed when they're in a good standing with the ATO and the purpose and the story make sense. And also if they know this client is in a strong financial position. And finally, if the letter is making statements of fact and are based on historical information. They're often not signed if the accountant doesn't know the client well, so often a new client. If the client is not an engaged client, if they're a client that is not very responsive, they have a bad standing with ATO, the story doesn't make sense, and they're in a weak financial position, and also their statements of opinion or statements about the future. These are when we'd find accountants don't like to sign these letters. So just to smooth this over and increase the chances of success, what we do is we make sure we build rapport and relationship with the accountant. So we call and make an introduction. We base our requests off analysis and numbers, not opinion or blanket requests. And we also read up on tricky topics or issues before we engage the accountant. So we do our homework essentially. And also when these letters are required, we will often do a first draft to decrease the workload for the accountant and make it very easy for them to finalize the letter. So we do give them the ability and opportunity to use their own wording and put any caveats that they might want to get the final result. So yeah, like I showed with the cleaning company, this is an example of a draft letter addressing the add backs that we want. And even an example with the entity exclusion. So we want these companies excluded and using the keywords that the lender wants to exclude companies that do not form the flow of income. So finishing up, in the ideal scenario, we're capturing the full flow of income in the application. All entities which generate income and receive the income are part of the application. The borrower and the guarantor has control of those entities, so they have a minimum 50% ownership of the source of the income and the recipient of the income. There's no volatile income, so essentially the business is growing in terms of its revenues and profits each year. We're using normal add backs, so the standard ones being interest, depreciation, and amortization. There's no related party loans, there's no tax debts. There's very good broker notes, and accountant letters are available, detailed, and ready for the client. Okay. Now, we know that not all this is always in place. So when it's not in place, just practical things that can be done to address this. So where income is leaked, getting an accountant's letter supporting that this income can be easily added back in future years for the client. When there's not sufficient control, so maybe the shareholding is less than 50%, we potentially want to change banks that have no minimum percentage requirement. Or we're presenting the scenario differently, such as using the salary alone or starting our assessment where income flows for that client. So maybe it starts at the family trust level rather than the core business level because they cannot exert direct control on the core business. If there's volatile income, we can use latest years or prior years. It depends. Okay, we saw that. We can prove that the business has recovered. If there are non-standard add backs, we can use document evidence such as invoices, get the general ledger from zero, get accountant's letters of support. When there's related party loans or Division 7A loans, we can establish that there's no cash flow impact on the client and use accountant's letters to support that. When there's tax debts, we can show that they can be added to servicing and still serviced, or we can prove that the client had or has the funds to pay out the tax debt, or we can make paying out the tax debt a condition of formal approval. As I said, a broker should have detailed notes, especially for self-employed clients. If they don't, you should change broker. We are happy to speak to you. A self-employed client, especially more complex, there should be a client memo, broker notes, or credit paper submitted with the application. And finally, if there's no accountant letter, then other verification that is independently verifiable can be requested. And also the broker commentary being very detailed and very strong can help as well.